Welcome to the Success Grid podcast again. Today I have a great guest, which is something that's known for being a huge and great person in the valuation business of real estate, industry, and government and infrastructure business, public and private companies. Some unique asset appraised by him are the Golden Gate Bridge, Atlanta Airport, Uber, AirBNB, and Yahoo. He also signed off over 4,500 valuation with 2.6 trillion in assets globally. Welcome, Bharat Kanodia.
Thank you, Hussein. Thank you for having me.
Hello. So let me ask you first, what is the most important aspect in respect to the valuing of a company in general? What is it that you are, as a person looking to evaluate a company, what are you looking for?
Great question. I think number one thing that I am looking for is some kind of a cash flow.
Yeah.
So if the company has cash flow as in profit,
Yes.
Or in some cases, if not profit, at least revenue, then that's the most important thing. Now,
So,
if a company does not have revenue, that doesn't mean it's worth nothing. It still might have be valuable, but the cash flow or revenue is most important.
so it doesn't matter if it's maybe negative cash flow. The important thing is steady and keeping going, and there is something generating within the company itself.
That is right. Even if the profit or the EBITDA is negative, still okay. But as long as there is revenue, and if the revenue is recurring, as in you get the same consistent revenue on a monthly or a quarterly basis, that's what's important.
Okay. So this has put me in another type of question: is what is the value of money itself, or the time value of money? Because maybe you are valuing a company when it's starting, maybe if it's valuing company a year later or 2 years later. When do you exactly decide to value a company?
I don't decide to value the company.
Yeah.
I value companies when somebody is looking to either raise money,
Yeah,
or they have just raised money, or they're looking to sell the company, or they need a valuation for tax purposes, or they need a valuation for estate planning purposes,
yeah,
or if they need a valuation for accounting purposes. Yeah, I don't get to decide when I value the company, but the ideal time to value the company is in the beginning and every 1 year after. So everybody should be valuing the company once
once a year. It's like so I understand. So maybe you do that when you actually do the year end of accounting and you get your financial statements out. So this is a good time to value the company.
Yes, perfect time.
Yeah.
As soon as your financial statements are ready, they're issued, get a valuation.
Yeah, and maybe the auditors have checked it.
Yes. Yes.
Yeah. So this is actually might be answering my question, why valuations matter to startup, or do you think you can add to this one? Why do valuation matters to them? You said that maybe some investments coming, maybe regarding the tax, the governments, something like that.
Great question. Valuations matter because valuation is like a scorecard. So say, for example, when you went to school, right, every year or every semester, you would get a scorecard saying that Houston did A in math, B in history, A in psychology, and B in physical exercise.
Yeah.
So similarly, evaluation is also some kind of a scorecard for a company, where it tells you how the company is doing and the different parameters that are important for a business.
So especially it could give some kind of certain operations, maybe it's doing more than operations. Like, for example, Tesla, it's doing a lot of things. So you will see where the things are going right or wrong here and there.
Very much so. Yes.
Yeah.
Good point.
Yeah. Great. So, but are these valuations, are they accurate or are they not accurate, or like 50% or are they coming 100% valuation? Is it something that an investor or a VC should look out and say, this is something I want to be in because this valuation is accurate?
I don't think it's a question of accuracy. I think it's a question of completeness or incompleteness of the picture.
Can you
So say,
expand
for
on
example,
this?
yeah. So say, for example, if you're looking at my phone, right?
Yeah.
You're looking on the back of my phone, you can see your own reflection,
Yes.
right? I am looking at the front of my phone.
Yeah.
Somebody's looking on the top, they only see
Yeah.
this much,
Yeah,
right?
it's a matter of perspective, maybe.
Correct.
Yes.
Correct. So valuations that you see in the media or in the stock market is only one perspective.
Uh-huh.
That is just a valuation. So say, for example, a venture capitalist invests $10 million in a company at $100 million valuation. That is one perspective. There's another perspective for tax. There's another perspective for accounting. So we only see one perspective most times. There are multiple perspectives. Say, for example, a person, I get to see the podcast side of Houston, right?
Yeah.
Now, you are probably a very different person when you're with your family, and you're probably a very different person when you're with your friends.
Yeah.
But I only get to see one perspective. I only get to see this much of
This
Houston.
side,
I don't get to see
yes.
this. I don't get to see this.
Maybe it's like in life, you need time to see some other angles of the person or the business or the
Good
actually
point.
because I watched, but it's off a little bit off topic, but I watched yesterday a movie called The Wizard of Lies, if you know this movie.
Yeah, good movie.
Yeah, it's
Robert De Niro. Yeah.
yeah, it's because the actual guy died a couple of days ago or something like that, Bernie. So yeah, I watched the movie and he regretted it, but he knew he was doing something not not good.
Actually, it was a funny, good point that you bring
Yeah.
up. I don't think he regretted it.
I don't
Because
know.
towards the end, he also said, "Yeah, I did something wrong, but other people will be to be blamed for it too."
Yeah. He's blaming the
Yeah,
SEC and they almost saw it and they didn't want to see it, something like that.
yeah. He's
Yeah.
blaming other people. It's like, hey, wait a second. They knew this was happening, and
And they didn't
it
do
was their own
anything.
greed.
They didn't do anything at all about it.
Yeah.
Okay, so this brings me to since it can be not 100%. Can a company have multiple valuation? So maybe company brings two, three, four, five, six companies or people to evaluate it for better investment to get more money from capitalists.
Right. So say, for example, this is my handwriting. Say, for example, this is my handwriting.
Yeah.
Okay. Now, a person A might say it's beautiful.
Yeah.
A person B might say, so.
So yeah.
Person C might say, oh my God, it is hideous. Right? So it depends on the perspective. So valuation is, I tell people, value is in the eye of the beholder.
So does a company need to get more valuations from more people, or do you think it's just one enough, or is it something that's required by the law?
No, there's no. If one valuation is good enough, but even if it's one valuation, somebody looking at it from an investment point of view has a different perspective. Somebody looking at it from a tax perspective has a different angle.
So like
and
we
then
talked about,
somebody looking at it from an accounting has a different perspective. So
so
one company, 3-4 different perspectives.
Okay, so let me say that do you see yourself in the business that some companies get way higher valuation than they actually deserve, like Uber, like I don't follow them that much, but for some years ago they said there is no net profit, but people keep investing and investing and investing. does that actually going to bring them the money that they put in?
Sometimes yes, sometimes no. So say, for example, there are three parameters why anybody values a company, okay? And if somebody says otherwise, call bullshit on it, right?
Okay.
Only three parameters. One is growth, right?
Okay.
So why is Tesla so valuable? Why is Uber so valuable?
Yeah.
Because everybody's saying, oh, it's going to grow so much, it's going to grow so much. So they invest in the growth today. Two, profit. If the company is very profitable, they want to invest in the company. Or if the company is going to become profitable very soon, they want to invest in the company.
So they expect it to be profitable.
Yes.
But
or number three, if they expect the company to become really big, right? Big is also good.
Globally, yeah.
Correct. Small ship, a small boat to an aircraft carrier, right? If it becomes big, it is difficult to sink, right? It is stronger. It is difficult to fight against. So if a company becomes big, less risky, in other words, that is also something people reward. So growth, profit, and risk.
Great points, by the way. But this is we're talking here about actual businesses that are brick and mortar. So when you look at it nowadays, it's a lot of people are going online. So what do you think about online businesses? How we can evaluate a website or a business or something like that?
Same things, the rules of valuation, Hussein, don't change, right?
The same thing, no change.
Same rules, all businesses. So if it's a brick and mortar business, or if it's excuse me, I have allergies.
No problem.
If it's a brick and mortar business, or if it's a online business, or it's an e-commerce business, it doesn't matter. The rules of the game are the same.
Great.
So think of it this way. Think of me as a veterinarian doctor.
Okay.
If you bring me a horse, if you bring me a dog, if you bring me a giraffe, if you bring me a fish, right? They all have a respiratory system.
Yeah.
All have a nervous system. They all have a skeleton and bone system, right? They all have a life. They all have an evolutionary cycle. They are born, they grow old, and they die. So similarly, companies have a similar life cycle and similar systems.
Yeah, everything in life has this cycle. We talked about maybe cash flow a little bit. So this is a very important thing to look at. Like you said in point two, it's a profit that you look to in valuation of a company. So having a positive cash flow is not necessarily the only thing. It's okay as long as there is revenues for the company. So this is the point, even for companies like Uber and other stuff. You want to see the company keeps growing, even if it's maybe cash flow negative.
Correct. So even if it's cash flow negative, you want to see the revenue growing, because if the revenue is growing and if they keep their costs limited, at some point it will become profitable.
Yeah, but maybe what happens if the cost keeps growing with the revenues?
That is generally not good.
Not good. So you would expect that company that may close. Maybe.
At some point it will have to, because at some point the investors are going to go, okay, I cannot put any more money.
Yeah, of course. Okay, so to me, I actually studied accounting in university. So there's one thing that's called market value and book value. What's your look on that?
So growing up, my parents would always say, Bharat, you're so handsome. When I would go and I would meet girls, Bharat, not so handsome. So girls are giving me my market value. My parents are giving me my book value.
This is not always true.
So it's just an example. So say, for example, a book value is assets minus liability. That's the book value of the company.
Okay.
Market value is, hey,
So
what is
it's basically the equity for the
correct
company.
equity on the books.
Yeah.
Versus market value is say, hey, what is somebody willing to pay for it?
Yeah.
Is anybody ready to go and date Bharat?
Uh-huh.
Maybe yes, no, I don't know.
Oh yeah, or maybe like when a big superstar comes and supports a small company, it makes a huge leap. Yeah, this is
Yeah,
also something different.
its market value goes up, right?
So you already, I think you already answered how to value a startup, or is it something that values from the things, the three things you said you look at: the profit, the risk, and the third one was the growth, right?
Yeah, startups are valued differently because startups, they are not profitable. They have maybe
Yeah,
small revenue, so
yeah.
they're valued based on um, a few things. So say one, they're valued based on what was the last transaction that had happened in the company. So if they raised capital,
Yeah.
did they raise $500,000 at $2 million valuation? So that's their last valuation. And how much have they grown since? Right.
Okay.
Two, um, is they're looking at what are other similar startups in similar industries selling for.
Uh-huh.
Or third,
For the same range of being in business.
correct,
Yeah.
correct. So been in the business about year, 2 years. They're in the same industry of, say, making, I don't know, laptop
Biscuits. Okay.
biscuits, um, or what have you. Or the third way is our investors are looking at that. Okay, I want to exit this company at $20 million.
Okay.
Okay, how long will it take for this company to become a $20 million
The
company? 3
company.
years, 4 years? Okay. And then they take $20 million back into 3 years. They also calculate how much money they need to put in between this time and this time, and they calculate the value today.